Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 282nd VideoCast podcast for the week ending March 13th, 2025. Got a lot of incredible stuff and one major announcement, but as always, family first. Spent the week out in New York City. Got to take my mom out to lunch. Of course, we had to do steak. Absolutely incredible. She's looking better than ever. Then had a golf tech lesson thanks to my buddy Jake Miller over there at Golf Tech on 40th Street, a block away from the apartment. You can see the good work he's been doing. Throwing out there a lot of 39s lately, but I haven't done two of them together to break 80. We'll get there, but you can see how close he's got the elbows here on the backswing. Nice bow, beautiful push draw. Super grateful for him. This is going into Fox. You can see Fox and Friends on Tuesday in the background. That's the studio behind the scenes. You can see the teleprompters that the hosts use and all the guests come in on these TVs. Absolutely incredible. Then we had New York Stock Exchange on Wednesday. That's the view above. Super cool. Never gets old. They put me into the VIP waiting room, which is new. And there's an article here from Warren Buffett. Couldn't help but get a picture in front of, and he explained why he listed at the New York Stock Exchange to reduce transaction costs. You can see the Olympic 1980 hockey stick. There was guitars from Metallica, like pretty cool stuff. That's the booth where we shoot the interviews. For those of you who've never been there, that was downstairs. The ones above were with NYSE Live. This is down on the floor with Diane King Hall at Schwab Network and a couple more picks. Then was at Yahoo Studio on Wednesday. And for those of you who've been around, you're like, I've seen these pictures before, but there's so many new people joining us and we're super excited. And I would have wanted the exact same thing behind the scenes if I was sitting in your shoes 20 years ago, taking a listen to this. It's pretty darn cool. You can see all the cameras and their introduction teleprompters and the timing. And that's where it all gets produced by the engineers. And then that was the Schwab on the floor in front of the NYSE. It's such a historic, amazing place. Some buildings around there and so on. Huge announcements, ladies and gentlemen. Next week, March 20th, we are going to have the most incredible guest on our podcast. Jeffrey Edwards, the CEO of Cooper Standard, is coming on Hedge Fund Tips with Tom Hayes. We are honored to have him. He's done an incredible job operating through a difficult environment and laid the foundation for what is going to be an exciting 12, 24, 36 months ahead. I can't wait to get him on and have an incredible talk with him next week. He's just a phenomenal guy, and you're going to love him as much as I do. So with that said, on to the media. As it relates to one of the aspects that I left out, we forgot the girls. Mimi absolutely crushed it this weekend. She had 9 goals and 4 assists in 2 games. They both won. Helped out her team on that regard. And then that was 14U, and Annabelle's 12U team simultaneously played in 2 tournaments, winning all 6 games. Annabelle had 4 goals and 5 assists on the Sunday as well, which is just unbelievable. I want to show my 2 favorite, and then we'll get right on with it. And that would be this one for Mimi. That's her. Boom. Little rocket. And this one I love. This was a backhander. We don't have time for all of them, but you got to check this one out. This one blew my mind. Boom. Literal backhander. I mean, anyway, I could play that one again. And then we'll do one of Annabelle's real quick. Love this one. Fake out at the goal. Breakaway with her wheels. And then goalie goes up. She waits and boom, tucks it in. Absolutely awesome. Every time I see those, it reminds me that I made a good decision moving out here for them and relocating. So it's all coming together for them. And I'm very proud of all the hard work that they're doing to make their dreams come true. Okay, moving along. Got a chance to be on for the first time Fox Business, Varney and Co. for the full hour. And I learned that when you're on for the full hour, which is rare, you are part of the And Co., which is and Company. Having a full hour is and Company. So was very honored to do that. Really want to shout out Christian Dagger, Preston Mizell. You guys are awesome. And of course, the great Stuart Varney, who had me on as well. So we're going to listen in. What I did, so you don't have to listen to the whole hour, is I spliced. So they do a 15-minute segment. 4 15-minute segment equals 60. At the end of it, they basically say, hey, Tom, what do you think about this and that? And we go into different things impromptu. So listen in here.
23. Tom Hayes is with us to help us through the market on a difficult day. Musk admitted that his time at Doge is making running his businesses difficult, but he says he's staying at Doge for at least another year. What does that mean for Tesla's stock?
Well, number one, thank God for the country that he's doing that for the country to bring down yields. That's a very good thing with the cuts. People talk about Elon Musk like he's a solopreneur working out of a WeWork office. I mean, this guy has thousands of people running his businesses. I think they're going to be just fine. I think this is a short-term thing. You have, consumer sentiment is a little low with the uncertainty in the short term. We see this every 4 years until we have some certainty of policy. So I wouldn't bet against Elon Musk. It's a round trip since the beginning of the election. If you own it, you want to bet on him the long term. If you want to buy it for the first time, let's get through some short-term volatility, and I think there's going to be an opportunity.
The uncertainty surrounding tariffs.
Yeah.
Take the big picture for a second. That there is uncertainty about the tariffs
no question.
And the implications thereof.
Yeah.
But that doesn't bother you.
No, every 4 years, if you look at the seasonal tendency in February and early March is weakness. And we don't need great policy. We just need known policy. And right now we're in a period of uncertainty, and we're just going to deal with this for another week. But look at earnings. Earnings were up 18.2% for the last quarter. The underlying economy is strong. Consumer sentiment's a little weak because of the uncertainty in the short term. But if we look back towards history, what we see after mid-March, once there's some certainty around policy, the market tends to rally into summer. So be using the red days to buy. We've been buying every red day since that huge flush last Tuesday. Then we got the 500-point rebound. Then we're down. We were buying yesterday in the hole. And we'll probably have 1 or 2 more opportunities before this thing kind of bottoms and takes off.
So you're serious dip buyers.
Oh, absolutely. Yeah. And it's high quality. Some things have been overshot. The number one thing about the Mag 7, the correction in the Mag 7, everyone says tariffs. A lot of them aren't affected by tariffs. So what's actually been causing it? It's the carry trade unwind. The number one chart people should be watching is Japanese government bond yields. And today they've backed off. They're at 20-year highs. They went to 157. That is a funding currency. People get free currency and they invest in the most crowded trade, which is Mag 7. As those yields have gone up, Mag 7 has gone down. Today, those yields have come down. And we should see some stability in the NASDAQ today.
That's an interesting interpretation of why big tech has been selling off. The carry trade, all right?
Yep.
Tom, stay there with me for the hour, please. There you go. Hey, Tom, the crypto firms would no longer have to register with the SEC. What does that mean, and do you support it?
Yeah, this was related to trading firms, and it was a bit of an overreach. They tried to lump it in with treasury traders, treasury dealers, which is completely unrelated. If they had a case, it should have been a separate regulation that had to stand on its own merits. They didn't have a case, so the Trump administration says no mas. If you are managing outside money for other people and you're responsible for other people like I do, you have to register with the SEC, and I think that's a good safeguard so that you're regulated and you're following all the rules and everything is safe for the client. Even if you're managing crypto, I think for other people, that should probably be under consideration. If you're managing it for yourself or you're a trading firm and proprietary capital, absolutely not. I think this is a good move.
But these changes are good for cryptos.
I agree.
Likely to increase their price and value.
I think, deregulation is always a constructive thing for the price of an asset, and I think crypto will be no different.
Tom, thank you. You're going to stay with me for the hour, I believe.
Love to.
Lucky guy. All right. Check it. Come back in, Thomas. You brought stock picks. You've gone back to the well. Crown Castle. You've liked them. They have gone up. Aren't they cell phone towers or something?
That's right. 40,000 cell phone towers, 7% dividend yield while you wait for the stock appreciation. And they're selling off the low return fiber business for over $8 billion to Zio Group. These existing 40,000 towers that they're going to be left with and all the cash, they require very little maintenance. It's just a cash machine that's going to pay you out dividends. They're going to buy back shares, and it's a rate play. So as Musk is successful with Doge and yields come down, these type of instruments, the REITs, go up because they trade on interest rates.
Wait a minute. If I buy it now at $98 a share, the yield is 7%?
Yeah, just in that range, and you're going to get capital appreciation over the next few years on top of it, and your yield will be locked in because you're buying low and selling high. That's what we like to do on this show.
Yeah,
right,
you're supposed to do that. Stanley Black & Decker, real fast. Why do you like
construction play, again, a play on rates. Construction has been down because rates have been high and new home starts and confidence and all that. That is going to come back as rates come down. They've taken $2 billion of costs out of the business. They overstocked during COVID. Now they've destocked. Now they're restocking. This play is going to be great. That $2 billion, gross margins are going up from 20% to 35%. This business is going to be off to the races. This is a leverage play. You say home builders are down. I want to buy home builders. Don't buy home builders. Buy Stanley Black & Decker. They're going to benefit when construction comes back in a leveraged way, much more so than the home builders do.
Sounds like an order to me.
I love it, my friend.
We'll take that. We'll take it. Thanks, Tom. Coming up, Elon. What do you think, Tom? What would a win against Canada look like?
I think even tariffs. I think the administration should put up a website and say, Canada tariffs us this, and this, line item, every single thing. We tariff them this, and this, and get those numbers even. That's all we want is fair trade, but have transparency and say,
well, that's reciprocal tariffs, isn't
reciprocal.
It? You want on April the 2nd.
We're not trying to start a trade war. We just want a fair and level trade. We import about 6 million barrels a day from Canada. That's good for our refiners. They refine about 60% of that, 4 million barrels a day. It's good for Canada because they have that heavy, thick oil. So there are a lot of good things that are happening between the countries, but we just need it even. We want our banks to be able to do business in Canada, just like they can do business in the U.S. So President Trump is using these tariffs as a way to make things fair, make it equal trade, make it equal regulation, let our banks do business with them, and this will be a positive thing when all is said and done.
Tom Hayes, thank you very much for being with us for the hour today. We appreciate it.
Thanks for having me.
See you soon.
And we're back. Then the day before, I was on Yahoo Finance. Want to thank Brad Smith, Maddie Mills, Justin Oliver, Taylor Clothier, and John Hyland. I will be on for a full hour next month in studio. I believe it's April 13th, that Monday. It might be the 14th, actually. April 14th, Monday, 10 a.m. for the full hour. Here's the segment for this week.
To fall after seeing their worst week since September amid mounting growth risks. Joining us now with more, we've got Tom Hayes, Great Hill Capital Chairman and Managing Member. And Tom, we've been speaking about whether or not this is a recession risk trade that we're seeing playing out in the markets. Where are you seeing buying opportunities? Are you repositioning at all amid the increased risks?
Yeah, I think this is a great opportunity. I mean, sentiment is basically flushed out. You've seen hedge funds selling in the hole like never before in the last 2 weeks. They're always a contraindicator. You've seen retail investors buying more insurance after the house is already half burned down. You want to buy the insurance before the house is burned down. Put buying is near a record high for retail investors. So we're in the normal seasonal pattern of an election, post-election year, which means February is weak, early March is weak. And why is that? It's because of policy uncertainty. It happens every single 4 years, and we don't need good policy. We just need known policy. And once we have known policy, look at earnings, up 18.2% for the last quarter. I think things are actually in a good position. But the one thing that no one's talking about that I think is more important than anything else is not tariffs. It's actually the unwind of the carry trade, which fueled the most crowded trade in the last few years, which was Mag 7. And all you need to do is look at 10-year yields of Japanese government bonds. And they've gone from 0 to 157. That's the highest rate in 20 years. And that was what we call a funding currency that had zero cost of carry, now has a cost of carry. So as that trade unwinds, the hot money is coming out of the Mag 7 and momentum stocks like Palantir, like NVIDIA, et cetera.
Yeah, I was going to ask you what the correlation is to the Mag 7 there. Why that matters when we see an unwind of the yen carry trade, and how that ultimately impacts some of the inflows or outflows, I guess, in this case, for the Mag 7.
Yeah, you can actually overlay the PE ratio of Microsoft to Japanese government bond yields. And you can see as Japanese government bond yields increase, okay, the cost of that capital goes up from zero to a carry cost, the multiple of Microsoft compresses. And that's over long periods of time. So while everyone's talking about tariffs, look, you know, you could look at JGB chart, you could look at tariffs chart. Tariffs chart, we're near 100-year lows in terms of tariffs. And what most people forget, as you hear Hawley Smoot every single day on TV, is that they raised tariffs from 1918 to 1929 for 11 consecutive years to levels much higher than anything we're close to right now. And the economy boomed before Hawley Smoot, when that was kind of the straw that broke the camel's back and coincident with a big sell-off that we all know about. But I think there's a lot of runway in terms of tariffs. I'm not pro-tariffs, but I'd be less concerned with that. I'd be watching that funding currency as it relates to the crowded trades of the Mag 7 and be looking outside of the Mag 7 for opportunities in the U.S. And be looking aggressively in international opportunities.
You know, I guess we're all talking about tariffs, though, because it's what all of the companies are talking about right now, too. Yeah. The FactSet stat most recently saying the highest number of S&P 500 companies citing tariffs on earnings calls over the past 10 years here. So this even moves through the last time in Trump 1.0 that we were thinking and talking about and seeing the implementation of tariffs. And so how are you hearing and assessing companies who are trying to bake this into their own forecasts for the rest of the year?
Yeah, I mean, welcome to Trump 2.0, same as Trump 1.0. As a matter of fact, I saw some analogs and overlays. You could see the stock market in Trump 1.0 when the tariff talks were escalating in accordance with the graph you're talking about. And we're effectively in the trough right now. We're going to get certainty. We're going to know a lot can happen between now and April 2nd. He didn't want to do it on April Fool's Day. Maybe he should have, because I don't think they're going to look exactly like they look right now on April 2nd. I do think the other thing that people are not really accounting for aggressively is if it is a worst case scenario, what it brings back on the table, which had been off the table the last 8 weeks, is the Fed put comes back into play. We've seen the odds of a Fed cut go up to over 85% in June. Just a month ago, everyone said no cuts in 2025. So here we are. We got the Trump put effectively coming back in potentially, but the Fed put coming back in. And oh, by the way, what's happened in the background no one's paying attention to? Bessent and Trump have delivered on what they said they would do, which everyone was laughing at when the 10-year yield was at 480. It's now down 60 some odd basis points. That's going to help refinance debt. That's going to help stoke the housing market again as 10-year yields go lower. And no one's really positioned for that. Home builders, you can't give away right now. Home building supply companies, you can't give away right now. And I think there's going to be great opportunity there with lower and lower rates. You're seeing it on the 30-year mortgage tied to the 10-year.
All right, Thomas, thanks so much for taking the time here with us today. We got about 20 minutes until the opening bell here. We'll leave the conversation right there. Appreciate it.
Thanks for having me. And we're back. And then I got a chance to join. Here we go. JD Durkin. Want to thank Mel Montanez and Kristen Scholler for having me on NYSE Live.
Welcome back to the show. This is NYSE TV Live. I am JD Durkin in studio here at the New York Stock Exchange, and joining me now is Thomas Hayes. Thomas is chair and managing member at Great Hill Capital. Thomas, welcome back. Great to have you here as always.
Thanks for having me, JD.
Let's start with your takeaways. A top line and core CPI reading, both a bit cooler than expected, maybe helping to set the stage for investors today. We're in positive territory, not by very much, but what'd you make of the numbers?
I think it's a big deal because as of yesterday, you saw the odds of a Fed cut in June go up over 90%. With inflation coming down, this gives the Fed the opportunity to be back in the picture. And if you remember, just a few weeks ago, people were saying no cuts in 2025. But what they were missing was the fact that seasonally, January and February inflation numbers are hot. It's a seasonal factor. We're now coming off the boil. Inflation's coming down. It brings the Fed back into play.
What is something about the overall markets you wish people were paying a little bit more attention to, or maybe something we're not discussing quite enough?
I think, number one, the big correction in Mag 7 was not attributable to tariffs because most are unaffected by tariffs. It was actually the carry trade unwind. If you saw the 10-year JGB yield shot up from effectively 0 to 157 in a very short period of time. When you're borrowing the funding currency and it has no cost, that's good. You can crowd into Mag 7. when that cost starts to go up, as we saw in recent weeks, people have to unwind that leverage because there's a cost of carry. So what have you seen in the last 2 days? Those 10-year JGB yields have backed up off the boil from 157 back down to 150, 150 range. The markets are steady, things are calm. Mag 7 ready for a big technical bounce here, but I don't think the theme for 2025 has changed, which is Mag 7 underperform. They'll do fine, okay, maybe trade in a range, maybe back to the top of this range, so we'll get a good technical bounce here, but real huge opportunity, unmagnificent 493, those boring companies, and international, which we've already seen take off like a rocket this year.
What are your expectations for PPI inflation data out tomorrow, and what does the Fed do with both this CPI print and tomorrow's print into next week's meeting?
Yeah, PPI tends to be the leading indicator. They've been a little better than CPI, even in the seasonally strong period. So I would expect it to be subdued like we saw today. That's a very constructive thing. That can bring the Fed back into play if we have further volatility. They can start saying, like, we stand ready to act. Right now, we're going to wait, be data dependent, as they always say, whereas before they're kind of like effectively alluding to the fact that they were done and kind of calm and patient. Now that they can say, well, we're paying attention, we can be in play, and that's what the Fed funds futures are reflecting.
I got about a minute. Let me ask you about a few of these names I know you cover closely. Let's start with Alibaba, up over 60% for the most part, knocking the cover off the ball, recently unveiling a new AI model. What are you tracking there?
This is an absolute home run. We've been building this position for 2 years, okay? So we started buying in the hundreds. We backed up the truck in the 60s. It's basis 83. It's absolutely taken off. It is just getting started. Do you buy it up after 60%? Wait for a pullback. You might get a little bit of weakness to buy it. But as far as some of the parts' intrinsic value, we're just getting started. This is going to be a multi-year theme. Their stimulus is kicking in. They've basically done a 180 on their policy. And Alibaba is best positioned as an AI play in China.
Let's close with PayPal, struggling a bit, not quite down to its 52-week lows, but it is trading below the 200-day moving average. What do you see with PayPal?
Bet on the jockey. Alex Chris is a winner. He came from Intuit. He ran 50% of revenues. That thing was a multi-bagger. He's applying the same principles to this business. He's going to generate $7 to $8 billion of free cash flow. They're buying in 15% of the company. It's a cash machine. Margins are going back up. It's a neglected business. This is a winner. It's going a lot higher from here over the next 12 to 24 months, in our opinion.
Thomas, I know it's always a killer interview when I sit there and say I could do this like for at least another hour. Unfortunately, we got to leave it there. It's always great to talk with you. That's Thomas Hayes, Chair and Managing Member over at Great Hill Capital. Thanks a lot for being here.
Thanks for having me, JD.
Folks, the markets are in positive territory, at least seesawing back and forth for the Dow.
And we're back. And last but certainly not least, I love this interview with Diane King Hall right from the floor of the New York Stock Exchange. Went through a lot of great stuff, and Diane remembers me because she was on Yahoo when I was pitching Baba under $100 and Generac under $100 and PayPal in the 50s. And she's like, boy, you are a contrarian. All those things are working out. So we gave her a couple more, and you're going to love this one.
And Tom Hayes, Chairman and Managing Member, Great Hill Capital. We put your full Thomas Hayes. I always call you Tom.
I prefer Tom. That's great, Diane. Good to see you.
It's good to see you. I always love chatting with you. All right, let's talk about kind of the broad market weakness we've seen first. I know I've got some notes from you. I want to get into Mag 7, but I want to initially start where we are with this reaction to tariffs. Tariffs were a hallmark of the first Trump administration. Yeah. It seems like it's going to be a hallmark of Trump 2.0. As well. What is your takeaway from the first administration with regard to tariffs and how to operate in the volatility that we see now?
Yeah, you can't make investment decisions on things that are outside of your control. So I always like to say, welcome to Trump 2.0, same as Trump 1.0. New headline, new tweet, new volatility, but resolves higher over time. And the thing we also have to keep in mind about these tariffs is what is implemented is a one-time level up. It's not 25% compounded at 10% per year. It's 25% one time. And that creates an environment where what we see every 4 years in a post-election year is February and March are extremely weak. Why are they always extremely weak every 4 years? Because it's policy uncertainty. We don't even need good policy, Diane. All we need is known policy.
Right.
And right now we don't know that. I think we're getting some firmness on that, and I think the market's ready to start to have a technical bounce here.
Okay. All right. Speaking of a technical bounce, I wonder what your thoughts are on the Mag 7. They've really underperformed this year as a group. You know, whether we're looking at NVIDIA, it's majorly down this year. Microsoft, Alphabet, Google, you name it, Apple as well. Only one that has a gain so far this year that I've noticed. I may be missing one, Meta. What is your expectation? Are you expecting to see some kind of technical shift here? Some would call them oversold. What's your thought?
Yeah, I do think we're going to see a technical bounce. It's interesting. Off their 52-week highs or recent highs, they're all down over 20% or around 20%, with the exception of Apple was down like 12.5%, 13%. Our theme coming in, as you may remember, was underperformance of the Mag 7. They had, and it's fundamentally driven. It's not just technically driven in that their earnings are decelerating from 33% last year to 16% this year. So they're re-rating in terms of price. So we're going to get a technical bounce, but I do think they're going to be a bit range bound, maybe back up to the top of the range for this year, underperform. Real opportunities are going to be under the surface, unmagnificent 493. And international. My goodness, the spread between international and domestic has been fantastic. I think that theme's going to reoccur like we see every 10 to 15 years. We've been 14, 15 years U.S. outperformance. It's time to shift back to some international.
So we have seen some international perform better, for instance, in China. Is the theme of U.S. exceptionalism over just for this year?
Well, when they shift, they tend to be for many years. As a matter of fact, Reagan's second administration, interesting parallel, international dramatically outperformed. U.S. did fine, but international dramatically outperformed. I mean, the spread between the tremendous 10 tech in China and the Mag 7 is 55% this year. Year to date, China tech's up 45%. Mag 7 was, actually it's more now, Mag 7 was down 15%, so that spread's about 60%. And I know this because we've been building a BABA position for 2 years that did nothing, and all of a sudden it went up overnight. And everyone's like, you're a genius. Well, it took us 2 years to build the position. We were buying in the hundreds, we were backing up the truck in the 60s, and here we are. So I think it persists.
Speaking of stock picks, I do want to get through some of yours. You got a few. You've got Baxter International, you've got Stanley, and you've got Boeing as well. Where do you want to start?
Let's start with Stanley Black & Decker, because that's the most hated. We're a contrarian, as you know, for a long time. Stanley Black & Decker is a construction play. So they're going to say, let's buy home builders. Home builders are down a lot. Stanley Black & Decker will benefit from lower rates because construction has stopped, consumer sentiment with the policy uncertainty, housing starts have stopped. That's all going to come back. We're seeing the 10-year yield come down. We're seeing that as an initiative of Treasury Secretary Bessent and Trump.
Scott Bessent,
Mortgages are priced off the 10-year yield. You see a high 5 handle on the 30-year mortgage, which will be fostered by.
You say we will see.
We will see
this year.
I think, but before the end of the year, you're going to see 5.99, something like that on the 30-year mortgage, and the housing is going to go crazy again. Meaning construction, meaning Stanley Black & Decker. They've taken, look, they overstocked during COVID because they didn't think they could get parts. They've destocked, now they're restocking. They've taken $2 billion of costs out of the business. That's $11 a share, and their gross margins, which troughed at 20%, are now reaccelerating to 35%. So this thing is going to earn money. Last time they had this kind of gross margins, it was a $50 stock. It's trading in the 80s.
Okay. We have a little over a minute left. I hate doing this.
What do you like?
Okay, Baxter. I really like Boeing because I know you just.
Let's do Boeing.
Yes.
All right. So Boeing.
I mean, when I say I really like it, because it's somewhat of a contrarian pick. You wonder if it's hit a bottom now, basically.
Yeah, I think we're there. We probably hit the bottom at 138. Then we rallied to 180. Now we're back into the 150s. This is a great final opportunity to get into Boeing. Why? Because look, love Boeing or hate Boeing, they made a lot of mistakes in the last few years. They've got Kelly Ortberg. He came from Rockwell Collins. He's fixing the thing. At the end of the day, it's a duopoly.
I know.
So if you say, I don't like Boeing, okay, go to Airbus and wait 25 years for your next plane. So they're going to mint money. They're going to do phenomenal. Global travel is growing. Their demand is going to, and the leadership. Now you have an engineer versus a salesperson running the company. They might actually build the planes right.
Yeah, all those production and quality issues. That,
That's right.
That's certainly something they had to work on. All right, Tom, we're going to have to leave our conversation there. I always love sitting down with you. That's Tom Hayes, Great Hill Capital. Thank you so much for joining us today.
And we're back. Want to thank not only Diane King Hall, but Heidi Schultz and Allie Thompson, newly back over at Schwab Network. So thank you for that. Want to thank Reuters for including me in their article on the market turmoil. And I continue to point to the Japanese yen because, candidly, most of our names are doing just fine. The ones that are affected by tariffs have just basically been grinding sideways. Some are a little bit down. The ones that have gotten smacked, we're not in. The Mag 7 are the ones that are getting all the pain, and they don't get affected by tariffs. So why are they going down when the media keeps telling you it's all about Trump tariffs, and the stocks that are going down the most aren't affected by tariffs? It's the carry trade unwind. We're going to cover it again this week. We've been warning you for months to lighten up on the Mag 7, and many of you did, and you saved a lot of money and made a lot of money because you followed us into the names that are working, whether it's Baba, Intel now. We're going to talk about all these. Also want to thank, speaking of Baba, Lou Bassanese. You can follow him at X. We talked a little bit about him last week. He's starting his own podcast on that he does. Follow him here, and he's got a newsletter, thebigskinny.com. Want to thank Lou because he was on Varney this morning, and I caught it, and he was pitching Baba, and he gave me the credit, and I'm very grateful for that. Again, that's a good friend, and that's a quality guy. What they do when no one's watching, and really, really.
One is Alibaba.
Yeah, Alibaba. I've come around buying cheap things. Price is what you pay, value is what you get. We were talking about AI earlier. This is a great way to play AI conservatively, trading at about 15 times earnings. Revenue is accelerating. Their AI growth has hit triple-digit growth for the last 6 quarters in a row. This is a name that is increasingly becoming less contrarian and more commonplace. Got to give credit to Tom Hayes, a good friend and fellow analyst, for putting me onto this one too. Dug into the fundamentals, and this is one in this market at 14 times earnings. I'm backing up the truck and buying some.
All right, Lou, thank you very much.
So join his newsletter, check out his show. Super guy. He's working as an executive with oil and gas roll-up down in Houston, I believe, and on Varney and all the shows on Fox Business every single week. You know him well. All right, let's talk about markets. First and foremost, the theme that I want to get across, which Besant did a decent job of explaining this morning, is everyone is stuck in this tariff thing and uncertainty. And this really does happen just like we said on the things, every single new presidential cycle the year after February and through mid-March tends to be very bumpy, very weak. And if you remember last month when the market was up huge in early February, I went on TV several times and we played it on this podcast. And I said the famous, buckle up, Buttercup, and get your shopping list ready because we're going to hit some air pockets. And that's exactly what we're seeing now. That's the bad news. The good news is not only do you see weakness in February through mid-March because of policy uncertainty every single time, you see a monster rally from March through the summer once you get a little bit of clarity on what policy is going to be. And what is that change going to be in our view? It's very simple. We're going to move from this tit for tat, fighting, punching it out on tariffs, which is ultimately going to lead to, we expect, lower tariffs on both sides because we'll say, okay, you're charging us 50% on our cars. We're going to charge you 50% on your cars. And they're going to say, well, we don't want 50% on our cars. We say, no problem. How about we do 25 and you do 25? They say, no, we don't, we want to charge you more. Well, that's not the way it's going to work. We either do even, or we'll do more than you, your choice. Because we have the market that you need to stay in business. And they'll say, well, can you do any better? Sure. How about we do 0 and you do 0? Would that make sense to you? Oh, no, we want to tariff you. Well, okay, then we want to tariff you. Oh, okay, let's do 0 and 0. And then you get real free trade happening. Am I saying that's going to happen on every line item? No. Am I saying that we're going to move in that direction because we do hold the cards in this? Yes. And are we willing to take a little short-term volatility for long-term reward? You betcha. And that's what's pretty darn exciting. I can't tell you the number of journalists who called me this week to talk about Trump tariffs. Why is MAG 7? They kept saying, MAG, all the tech stocks are down. When is this tariff thing going to end? I said, what does this have to do with tariffs? Like, does Google export search to Mexico, or do they get their search product from Mexico and Canada? I mean, this is just, you can't make this stuff up. So anyway, it's absolutely crazy how emotional people get. And when you just zoom out, as we say here on Hedge Fund Tips with Tom Hayes every week, and actually burden yourself with the facts. Hold on, I'm going to go get my buddy's hat. Here we go. By the way, I got to figure out what we're going to do with these hats. Obviously, this is my buddy, friend, and client, Damian L. Burden yourself with the facts, Great Hill Capital. We got like 10 of these. I got to do some type of promotion with these, but we'll figure that out. So let's just dispassionately take a look at the markets briefly. We've talked about everything we needed to talk about on the markets with the 4 interviews in 3 days. So here is the put call ratio. It's elevated. It's not at an extreme, but it does look like kind of a downtrend. Maybe it goes up a little higher after this week, and we'll be up here, and we could say, all right, if it's not going to be a huge type of thing, we'll be fine. I got to be honest with you. I mean, I'm even looking at today, which closed pretty weak, and our aggregate portfolios are up today. I'm not saying that, like, it doesn't matter. The point is that because we are truly active managers, this type of positions we take are uncorrelated, where you see a lot of active managers that are closet indexers. They're basically copying an index fund and then just moving the needle in terms of weights at the margins to hug the benchmark, get their fees, have the pension consultants check off because they don't outperform or underperform. So everyone gets their jobs, everyone gets their fees. We do the exact opposite. Like if you compare our holdings for clients relative to any index, there's going to be absolutely no rhyme or reason. We run it like private equity in the public markets. We underwrite each position as if we're buying the entire company. And then we just try to buy companies in different industries. So we have discrete, uncorrelated bets with huge margins of safety that we can get a minimum double, triple in a reasonable amount of time, 2-3 years. And we rinse and repeat over and over and over. And we do the turnaround Tom special, durable, proven businesses over and over and over. So speaking of which, in 2 weeks' time, April 1st, we will open up for Q2 opening for the small accounts. Those of you who've been around know our minimum used to be 5 million, and they could come in whenever they wanted, and that's been great. And for those accounts that have a better deal, by the way, they can come in anytime they want. They get bespoke service. For the smaller accounts, which we opened up over a year ago and has been very, very successful, we open up once a quarter so we can manage that all in a week or two and then just get back to investing. So those of you who are going to be coming in April, and I would imagine if you've been listening to this podcast for a while, you want to come in when a lot of these opportunities are available versus when everything's up, just go to hedgefundtips.com and click on money management, enter your information there and make sure you qualify. And then we can start to get back to you in the next week or two, and you'll be first in queue when that opens in April, and you can have your application set up and we can take it from there. So Let's take a look at where we are in the extremes here on a chart by chart basis, just to separate emotion from reality. You can see most of these indicators that we look at from time to time are extreme and coming back, or close to extreme and coming back. NASDAQ, declining issues, tricks. NASDAQ, Cohen high low. This is pretty extreme here. Could it get more extreme if it was a big event? Sure. We're right at correction territory on the S&P, largely driven by Mag 7. All of the Mag 7, I think excluding Apple, are down 20% or more. And it's interesting because if you recall, those of you who've been listening, we bought Amazon and Google in the hole in October, November 2022 during the tech crash. And they were pretty quick, basically doubles. And we sold out of those, and we sold out of all that stuff and the banks in July. And they actually went up more after we sold, and we're just like, okay, whatever. They just got rich. We made our money on those. And now they're back well below that. And it just goes to show you things overshoot on the upside. They overshoot on the downside. We take the middle out, and we're super excited about that. Some of these are getting ready for a big technical bounce. But as I said in the interviews, I believe they're going to be trading in a range and underperforming for the remainder of the year. Our theme of international, maybe that'll come off the boil because it's had such a big move in such a short period of time, will persist, though, through end of the year and beyond. So that's where we're going to continue to focus. But you can see a lot of these sectors are getting completely oversold. Materials, there's so much to do in materials, so many new names that we're researching and ready to allocate to in addition to our existing one. Healthcare, kind of mid-range. Intermediate term volume momentum. So like often this was a bounce area. Sometimes it gets to a more extreme. We'll see if that's the case this time. But Dow is getting close to buy all. S&P PMO by SPX is kind of at the level you usually get bounces. Could get a little bit more extreme. Maybe we flush Monday and then turn around Tuesday. We'll see. Bullish percent S&P 500. This is an area where you tend to get some bounces unless it's an extreme one. But I like the risk reward here, and I like it on a discrete basis. As I go through a lot of the names that we talked about and other names that we own for our clients that we haven't talked about, I just love where they all are. And some are going well against the train, well against the grain. While everything else is going down, they're going up. You've seen it obviously in BABA. You now see it in Intel, which we're going to talk about today. And several others. And we think that's going to continue. And then a lot of them are just sitting there, like Advanced Auto Parts, like Stanley Black & Decker, just sitting and waiting. So while the market's crashing around them, they're kind of just in this holding pattern. And I think usually what you see in crashes is a new leadership group comes out. And I do think as the rates come down, we're going to see a lot of these just skyrocket, even including Generac and others. Here's the McClellan oscillator. That was the NASDAQ one. Here's the NYSE one. So again, you get these flushes and you get the, kind of checkbacks and then straight up. So I think we're mostly there on a company by company basis. This might have to work itself a little bit through, but here's the volatility index spiked up. It's way too late to buy insurance. For all the people, we have record put buying this week. We have record selling in the hole. That's the kind of stuff I like to see. And we're in the market on red days buying stocks, and that's the name of the game. So moving along here, we got double of these. There we go. Quote of the week: if you want to have better performance than the crowd, you must do things differently than the crowd. Not be a closet indexer, not chase the shiny objects that we warned about. And we covered last week how badly all of them have been hit. I mean, it's just staggering. It's funny because, people know I'm in the markets. They're like, how you doing? I'm like, pretty well. How are you? They're like, oh man, it's so bad. I'm like, what do you mean? And they're like, all my tech stocks are down. Like, it seems like, in talking with the average bear, even the average money manager, they are so concentrated in all this stuff that got shellacked. So while the indices are down single digits, I mean, some of these guys are down like 30, 40% because they had all that stuff and they had it with leverage. And, you just got to know when the crowd is getting swept up and step aside and lose the FOMO gene that leads people to these outcomes. Some of this volatility you saw, Millennium, huge hedge fund kind of blowing up. They had a note on Bloomberg. One of the strategies was like completely forced selling last Friday. Bally Gifford, a growth fund, they're getting smoked. So think differently than the crowd is the name of the game. And here's the master, Warren Buffett himself. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. And I'm noticing a lot of the smart, some of my smartest clients have been calling me this week, basically saying, are we allowed to put money in, in the middle of the quarter? I'm like, yeah, you're already an existing client. You can put money in whenever you want. Just give me a heads up so I know there's cash there to deploy right away. Anyway, I love environments like this. This is my favorite time in the business, is to be around during periods like this. Especially when we saw it coming and we were talking to you guys. So y'all buckled up, Buttercup. I know you didn't own any Mag 7. And here we go. So here is what I'm watching, though, for this, whether or not this turns into something more serious, is the high yield option adjusted spread, basically high yield credit spreads. This is very, very, very subdued, very open up. I think we've got a few more years. I think this is going to look a lot like 2001 to 2007, which we've talked about. And we're kind of here. We could see these spreads blow out a little bit if it gets crazy with the tariffs, but right now they're doing well. That's what we keep. This is the chart that no one's paying attention to, that we've been talking about for 6 months, is to watch the Japanese government bond yield and watch the carry trade unwind. All of this hot money is coming out. And while all the media is blaming tariffs, all the money's coming out of Mag 7, which are unaffected by tariffs. Why? Because Japan has been printing money for 3 decades. They're getting inflation, and now they have to raise rates to quell the inflation. And every day you see this go up, Mag 7 goes down. Today was no different, and we will continue to see this. So that's why for 3+ months, we've been suggesting, lighten up on your Mag 7. This is not good what's going to happen to those crowded trades, and what's going to happen under the surface is fortunes are going to be made. And we got our first taste of it, barely a taste. It's like a sample when you go to the ice cream parlor. We're going to get the whole sundae in coming months and years, which is what's happened with Alibaba. That's just the beginning of what's going to happen. What happened today with Intel, all of these things. I mean, I'm super excited about Intel. As a matter of fact, it was so funny. I saw the news last night, and I was flying home from New York, and I get in this morning, and I'm like, I know I bought a lot of Intel. I really hope I bought enough. And I look, and I'm looking at the position. I'm like, oh my gosh, this is our 3rd largest position. This is unbelievable, because it just kept going down, and we kept buying more. It was like went 19 to 23, and then it dropped back to 21, and we bought more. Then it went up to like 25 or 26, then it went down to 21. We bought more. Because why? Because it was trading. If they liquidated the whole thing tomorrow, we would have got back like 20, 25 bucks. So we had our downside protected. If they completely screwed up the fabs, we'd probably have a double on the legacy business with the refresh of CPUs. And if they actually got anything right, we'd have a triple. And if they really got someone to run it, which they, by the way, they just did, this thing could be a 5-bagger plus. Because guess what? your Broadcoms, your NVIDIAs, your chip quote unquote designers think that they're brilliant, but they rely on the kindness of strangers. If TSMC goes away tomorrow, NVIDIA ceases to exist because no one can produce their designs. So Intel is going to solve that problem for the world and help them out. And they're right now testing NVIDIA chips and Avago chips or Broadcom in Intel factories. And the 18A is looking better than everyone expected. And now you got a winner, which you're not going to believe what I have to say about this guy today, who's going to run us and take it to the promised land. I thought Gelsinger could do it because he was on the 5-yard line. This guy is going to be able to spike the football, not just once, but probably 5 times. It's going to be a complete blowout as they increase capacity. And by the way, the turnaround for those of you who are in NVIDIA and just got slacked, NVIDIA's next phase will be dependent on the success of Intel. So if you're playing NVIDIA, you're better off getting more leverage playing Intel, because if NVIDIA is going to double from here, Intel is probably going to 5x from here, is really what it's going to take. And honestly, I hope that happens. I hope NVIDIA doubles from here, because the only way they're doubling is if Intel provides the excess capacity, because even if TSMC breaks ground on $150 billion of factories tomorrow in Arizona or Ohio or wherever the hell they want to put them, it's going to take them 5 years. Intel's been wasting money for the last 5 years, but they're ready to go. So there you go. Just like everyone talking about tariffs affecting Netflix. What is the effing carry trade? Wake up. Look at this chart every morning. Stop looking at the S&P. Just look here. If it's going up, tech is going to have trouble today. If it's going down, tech is going to rally and probably in big violent bounces when it eases up. All right. In preparation for our amazing special guest next week, the CEO of Cooper Standard, Jeffrey Edwards, I want you guys to impress this chart in your brain. This is U.S. SAR going all the way back to 1967. So almost 50 years, more than 50 years. We're basically almost 60 years. And what's the common denominator, ladies and gentlemen, is that SAR peaks out every single cycle. Every single 7 to 10 years, you have peaks and troughs. This is the definition of a cyclical business. It's why we bought it when we bought it at the bottom of the cycle when no one wants it. It peaks out between 17 and 20 million units. 17 and 20 million units. So our whole thesis was predicated on in 2017. They had 17.1 million SAR. They generated $7.19 of earnings because of all the operating leverage as you get over their break even, which is 15.1, 15.3, whatever it happens to be in terms of production. And they minted money. So at $7.20 a share, the market assigned them a 20 times earnings multiple, and the stock was $146. They have since taken out tons of costs, 500, 600 million in costs, which means that if they get the normal cyclical top between 17 million and 18 million, the thing can earn $7 to $10 plus. I think it's going to be over $10 a share. We're going to talk about potentially why next week. We're gonna stress test our thesis on the CEO and see if he agrees or disagrees. And he also has the right to not answer and nod and smile and not respond if that's what he chooses to do. But here's the other thing, ladies and gentlemen. So we're like, oh, if we could just get that back to 17 million. Okay, let me tell you what didn't exist the last 4 times that we peaked well above 17 million at cyclical tops. I'll tell you what didn't exist. Number one, you didn't have cars that were on average 13 and a half years old, the oldest that they've ever been, breaking down by the minute. So number one, that didn't exist. I'll tell you what else didn't exist. The number of human beings in America didn't exist. And take a look at this, ladies and gentlemen. In 1986, which is very similar. Second term of Reagan after coming off a depressing 1982, which was attributable to what, by the way? The huge Volcker tax, the huge Volcker rate hikes, just like we had with Powell here in 2022, that crashed the car market. It came back just like this, trickled up here, and then just spiked when no one expected. A little bit of fake back, maybe we'll get a little bit of fake back, and then a huge spike up to 17, 18, and then 20 million, 21 million SAR by the end of Reagan's term. So, two things that didn't exist during that, ladies and gentlemen. Number one, rates were a little higher, even though they'd come down off the Volcker high. Okay, leave that aside. Okay, we've got how many people in America right now? About 330 million by the US Census. Do you know how many we had when they did 20 million SAR after the Volcker hikes crashed the car market? They only had 226 million people, ladies and gentlemen. So they did 20 million cars catch up on a third less of the people, 100 million less people. They did 5 million more cars. It was catch up after rates started coming down off the peak, and you had Reagan part 2. Well, now we've got Trump part 2. The only difference is from 226 to 331 is almost a 50% increase. We got the cars that are older than they've ever been. It would not shock me, okay? And I was too damn conservative when I bought this company at $5.10 and $5.50 in May of 2022. I mean, don't get me wrong, we own a ton of it, but and we've added every single opportunity. New money came in today, I'd be buying a ton of Cooper Standard at $13 and $14 all day long, personally. And I will, by the way, and new money is coming in this week. So just from existing clients, because we're not open to new smaller accounts until April 1st. But I think we're going to hit 20 for a minute in this cycle. And maybe we're going to get a fake back before that with a little bit of the consumer confidence in the second quarter, although they're going to pull forward production in the first quarter because of this deadline, which may prove to be such a blessing in disguise. Imagine they do this deadline, they pull all this production forward, the tariffs aren't as bad as possible, and you keep those elevated production levels, and the business is set up to just absolutely mint money. So this is the biggest thing that I had never thought about. Is I kept saying, well, we're going to get back to 17 to 18 because we've done that every single cycle for the last 40 years. And by the way, the 70s, okay, which peaked at like 16 and change, which they'd still probably earn $5-6 a share, and we're going to talk about why. The population was only 203 million. I mean, you can't make this stuff up, ladies and gentlemen. I think there's so much pent up demand we could wind up. But just on 17 and a half, I think we easily do $10 a share. And I'm going to explain why next week. And God forbid we actually get to 18, 19, 20. Then the question is, what multiple do you apply? Maybe we don't get a 20 multiple like we got in 2017, or they got in 2017. I didn't even know they existed in 2017. So maybe at $10, we only have a $100 stock. Well, we're a $13 stock now. That wouldn't be the worst case scenario. What if we get a 15 times? What if we get a 20 times multiple? I am so excited about next week. But I'm also excited about this week. Why? Because Intel's getting upgraded. Why? Because Lip-Bu Tan was appointed the new CEO. He was on the board. He resigned because he didn't like the direction they were taking. They came back. They begged him to join. That's exactly what's happened. And all these words, I mean, this is almost comical, by the way. These firms came out, Bank of America, Merrill Lynch, Morgan Stanley, they come out and say, oh, this CEO looks good. Why? Because the stock was up 13% overnight, so they had to take their price target up from 20 to now 25. I mean, you're taking your price target up $5 on Lip-Bu Tan. Are you smoking crack? I mean, let me tell you what Lip-Bu Tan did at Cadence Design Systems, okay? He came into Cadence Designs January of 2009 after the stock was down 85%, okay? And it was trading at $3.50 in January of 2009 when he was appointed full-time CEO. And over from 2009 to when he left as executive chairman on May of 2023, the stock went from $350 to $239. Okay? So basically, in 14 years, you had a 68 bagger. If anyone knows how to run a turnaround, it's Lip Bu Tan. And that's 6,800%. And for those of you who don't add well, okay, $1 million investment when he became CEO became a $68 million value by the time he stepped down 14 years later. 1 million became 68 million. 100,000 became 6.8 million. 10 million became 680 million. 100 million became 6.8 billion dollars, riding this winning jockey who knows the business inside up, out, upside down, and sideways. And these schmucks are upgrading at $5 a share. You can't make this stuff up. But if it wasn't for people like that, we wouldn't have opportunities like this. Bet on a winning jockey, ladies and gentlemen, and watch what happens. Total option put volumes, moving average 5-day. Retail investors buying all the insurance available in the world after the house is burned down at the highest prices possible. Do you think these guys are going to get paid out on their puts in the hole? No, the sellers are going to make bank. The buyers are going to lose 100%. It's the way the game works. It's the way the game has always worked. There's no way in hell. Even if the market continues to go down for the next 2 weeks, I guarantee you by option expiration, where you look where all the weights are, which is probably in April and May, I guarantee you these things aren't paying a goddamn penny to one person who bought a put option in the last week when they went to record all-time highs, which always marks a bottom, ladies and gentlemen. Here we go. Bull bear spread, again, extreme that we have not seen basically since the COVID lows in 2020. And that was a time to be a buyer, not a seller. 2020 was a little different because it was more pronounced. When you have a drop this steep and this pronounced, it tends to recover more quickly. And I think that's where we are. So even if it goes a little lower, maybe flush Monday and then turn around Tuesday, we'll see. I think we're basically there. And we're certainly there for the type of stocks that we buy. As would I be, if you put a gun to my head, would I buy would I, they say you got to buy a Mag 7. Maybe I'd buy some Amazon here. Maybe I'd buy some Google. I don't know, man. I've been using Grok, and that is the most incredible thing. I'm really impressed by Grok, which is Musk's AI through Twitter. So I don't know. But they've got Yahoo and they've got the data center business. They've got all that stuff. But I'm not, no one's putting a gun to my head. So therefore I'm going to buy the things that I feel comfortable, have a huge margin of safety. I don't have to worry about the market every single day. I know what the business is worth, and I know I'm going to get my doubles or triples in a reasonable amount of time, rinse and repeat over and over. This is a phenomenal thing a friend did for me because I've been talking about the carry trade unwind, and we showed last week how the Microsoft PE contracts as the 10-year JGB yield increases, showing that the carry trade is in fact impacting things. Here you can see it a little clearer, although it's not concentrated to the Mag 7, which I think is the most crowded. It's just NASDAQ 100. They did the currency thing too. I don't really care about that. What you can see here is the green line is JGB 10-year yields. They get these abrupt spikes and you get a crash in, when they spike up, the NASDAQ in blue crushes. So it's an inverse relationship. You get the spikes in the 10-year yield, Japanese government bonds, which means the carry trade unwind. You get a deleveraging in the crowded trades. Spikes and then deleverages, spikes and then deleverages. And this is, this is just the way it works. This shouldn't be surprising, but apparently for those. You remember last year we were showing this chart and we said we'd never seen an opportunity like this, how overvalued the Mag 7 was relative to Chinese tech. Double top, double bottom. Well, what's happened? This has gone straight up. This has gone straight down. They are converging. These divergences are where fortunes are made, and we're at the early stages, ladies and gentlemen. Here we go. Hedge funds have dumped stocks over the last 2 weeks at the fastest pace in history. That is a contra indicator. They did this exact same thing in late 2020 when we were buying until our hands were sore. The tech that they were selling in the government. We're generally not tech investors, but it was so damn cheap to buy Amazon and Google and Meta. I mean, you can't make this stuff up. Same thing happened in 2018 in the beginning when there was the tariff talks, and then sure enough, you got the rally into the summer. Everyone forgets that. Memories are short. This is a better characterization. We're kind of like right here, ladies and gentlemen. So if we get a final flush, or if we got it this week, I don't know. And then you just go straight up into summer is effectively what happens. Stiefel upgraded VF Corp this week to $35 price target. We're going to spend some time on that in the article of the week. This shows the different drawdowns throughout the years and recoveries. Here's the Bloomberg Dollar Index, again, just rolling over as we had anticipated. 10-year government bond yield, this is now 157. That's why you saw volatility in tech this week. And not really a lot else, mostly just tech. And China tech was up, and the businesses that have a large enough margin of safety, people are just crowding out of as the carry trade unwinds, and you have forced structural liquidations, redemptions from those funds that were overweight, got smoked. Better than DeepSeek and OpenAI. Alibaba touts open source AI model that beats rivals. And they've also said it outperforms DeepSeek and it uses fewer resources. So what was the theme that hurt NVIDIA? DeepSeek said we can do the same or better with a lot less chips. Well, now Alibaba's saying, thank you, DeepSeek. Not only can we do better than OpenAI and better than you, we can do it with even fewer resources than you have. So suck it is what they said. It's basically what it comes down to. So there we go. So S&P 500% of members above the 200-day moving average. So breadth is closing in a little bit. This seems to me like where it wants to settle out. We'll find out. Worst to first, trailing and predicted 10-year total return by stock category. Well, everyone was saying U.S. exceptionalism. Now it has the lowest expected return. Everyone was saying stay away from international or stay away from emerging markets. Now it has the highest expected return for the next 10 years, over double digits, and developed ex-US. You couldn't give it away 2 months ago. Now it has the second highest expected return. So amazing how quickly things change. Last shall be first, ladies and gentlemen. You remember the themes in the articles, so that's playing out before your eyes. Fed Fund futures. This is a complicated chart. All you need to know is last time I looked at it, yesterday, June chance of a cut went up to 90%. Huge outflow from crypto this week. So all the leverage trades like Mag 7, like crypto, like the risk on that are dependent on free funding currencies are getting unwound in recent weeks. Largest 4-week inflow into European equities in 10 years. Okay, so this is the kind of thing that you saw when 2001 and 2002, when emerging markets and international and small cap and value outperformed for 7+ years. All the conditions are setting up. Everyone on this podcast the last 6 months knew it was coming, prepared for it, and now we're taking advantage. So congratulations to you. And for those of you who are new, there's still plenty of time, still incredible opportunities to get money to work soon. The window's going to close very, very quickly, but now is the time, and super duper excited. You know, it's like a lot of people are like, yeah, but I feel like I missed Alibaba. And you said to come in January and all that stuff, and look what's happened to Alibaba. And that's absolutely right. You did miss it. But that's the bad news. The good news is, we have more ideas than we have available capital. We're fully invested here. I mean, this is the time you want to be buying on red days. This is where when you look back 12 months, like we did in March of 2023 and October of 2022, when we were pounding the table, those things don't come around all the time. And there's just so much exciting stuff to do right now. And this is like a kid in a candy store. I got to be honest with you. Core risk model. This is getting to an extreme. That's from macrocharts.com. So that's that. The momentum ETF cracking, of course. Hang Seng broke out, back tested, and now it's green again. So, it's so funny because now everyone's coming to me and asking, should I buy Alibaba? And I feel so bad. It's like it's up, more than 100% off the lows, and in a relatively short period of time. And I know it's going up a lot more, but like to tell them to buy, I'm like, well, hopefully wait for a pullback. I just don't know if you're going to get it. We kind of got it into the 120. So it's like, do I tell them to buy at 140 and then it goes to, 125 and they're like scared or whatever before it goes to 200? I don't know. You should have been listening a year ago when all of us were on here white knuckling it at $60 and $70 saying, yeah, I'll buy more. And bringing our bases down. And I mean, it's just fun. All right. So there we go. Relative performance. Max drawdowns. What else do we have here? AAII bearish sentiment at all-time highs. We haven't seen this high bull versus bear ratio since the lows in October. The last time I was this giddy about opportunity. So here we are again, ladies and gentlemen. So that's that. The only difference is I know that the Mag 7 are going to technically bounce and probably have a violent bounce here at some point. But I don't think they're going to trade above their range for a while. I think they're going to continue to underperform for at least the next 12 months. They're great businesses. They just got ahead of themselves. And I think there's just so many more better risk rewards. And even if I bought, if someone put a gun in my head and I had to buy Amazon and I was right and it went up 50% over the next 18 months, I don't get into any stock for 50%. If I can't get at least a double in 2 or 3 years, I won't take any risk of capital. So it's got to be at least a double plus. And I just don't see it in those names at all or anything close to it for the foreseeable future. Over the long term, yeah, for sure, probably, but not in the short term. U.S. stocks lagging global peers by record amount. This has even become more pronounced. So it's like a 15-point spread. If you go tremendous 10 China, the top 10 Chinese tech stocks, relative to the Mag 7, the spread is now almost 65% year to date because China Tech's up some 55. No, it's almost 70%. And Mag 7 was down 15 as the basket. It might have got down 18 now. I mean, it's unreal. I mean, I couldn't have made this stuff up. And then what does Citigroup do after China Tech doubles and Mag 7 crashes 20% and more in many cases? Citi downgrades U.S. stocks to neutral after like 3 weeks ago. It was all about U.S. exceptionalism. Upgrades China to overweight. I mean, oh my gosh, it's like watching a comedy movie. I mean, Steve Martin should be writing these upgrades and downgrades. Maybe we'll get Will Ferrell to work for Citibank and write some of these papers. Fear and greed index. This is not where you want to be a seller, ladies and gentlemen. Yeah, these things can bump around for a couple of weeks, but it's extreme fear. It's palpable. Not only did we get the upgrade in Intel and we got it in VF Corp, but we got it in GXO Logistics, ladies and gentlemen. Stifel put it out with a buy, $66 price target. They're doing good work over at Stifel. Those guys are awake and got some friends over there that are just doing great stuff. So kudos to you. And guess what? Price is what you pay, value is what you get. We're still buying the things with the greatest value for the least amount of price. Highest earnings growth, lowest multiple, emerging markets, China, ex-US. US still has the slowest earnings growth for the highest multiple. So yeah, keep crowding into those trades. And as the carry trade unwinds, you're going to continue to get monkey hammered every single week. You'll get your technical rallies and then you'll get smoked. And it's just going to continue on like that for some time. Mag 7 index drawdown. I mean, over 20%. And this, I think, was March 10th. That was 3 days ago. It's probably 22, 23% for those people who are concentrated in the most crowded trades. Stock winners become the biggest losers. So this is a way of saying the last shall be first, or the first became last. What's the best? Healthcare, which we talked about, remember, at the end of the year. Materials is up there, still not flying yet, but up there in the top groups. What's the worst? What was first? IT, some consumer discretionary. There's going to be some opportunities in consumer discretionary very now, like right now. So that's that. Cyclical over defensive, total return ratio. You can see that rolling over. Mag 7, catching down to European defense stocks. Mortgage applications are spiking up. This is our theme, guys. People looking at me like I'm sideways. Housing's going to come roaring back when rates come down. Besant's got it. He's got it handled. And the Fed will now be back in the game. The Fed put will be back in the game. We're going to see a 30-year mortgage rate below 6% sometime this year. And when that happens, these mortgage applications are going to go from wow, like we've seen in the last couple of months, to they can't make a chart large enough for how many applications are going to happen. Why? Because the third thing that I didn't cover as it relates to CPS is not only is the population bigger and the cars are older, but the third thing that I didn't cover is the bulk of our population is 34 years old. And the number one time that people buy an extra car and a new car is when they start families and when they're in their peak spending and peak earning years from 30 to 40 plus is when they spend all the money on extra cars and they buy a new house, they move out to the suburbs, they have a kid, they buy dishwashers, they buy all that stuff. And that's the kind of stuff that's going to fly for the next 5 years. And you heard it here first, but do you play like we make the analogy with with Cooper Standard, do you play the OEMs who are going to be duking themselves out for volumes and margin compression, or do you pay the arms dealers who benefit from higher volumes? And we're playing the arms dealers, the Generacs of the world, the Stanley Black & Deckers of the world. So while the supply of houses is going to pick up rapidly when these rates come down, and they're going to be fighting against each other, the suppliers like Stanley and like Generac and the other covert housing plays are going to hockey stick with huge margins because there's no one else left in town, and they're the best brands in the business, with Generac having 75% of the home standby generators, DeWalt, Stanley, Black & Decker, Craftsman, the best in class. If you're going to construct something, you're going to use their stuff. This was the fastest market correction since 1950. Here are the list. This was the 5th fastest. Those tends to get pretty big bounces as well. Here's the performance of the Mag 7. This is a little old, but Tesla round tripped it, down 52%. NVIDIA was down over 30%. The rest of these were all down over 20%, except for Apple was down close to 20%. So that's that. Where are we at here? We're almost done with these. Fund flows into the biggest U.S. listed European equity ETFs is the highest since 2017. China large cap ETF, FXI, still has an all-time high short interest. The only time you had a short interest this high, or even close to this high rather, and it was only a third of as high as it is now, it was a record back then, was in 2016 when you had a parabolic move straight up in Alibaba and Chinese tech stocks. Was the last time you had this level of short interest. Now we've got 3 times the short interest. The more we push higher, the more these guys are going to be forced buyers and unnatural. And that's why I told you when we were at 60 and 70 and $80 that once this thing goes, they're not going to let anyone in. And that's exactly what happened. I mean, it didn't let anyone in, and it's still not letting anyone in, and it's probably going to push higher, and all those people that missed it are going to miss it more, and they're going to be forced to buy it over with a 2 handle in front of it, and really get the, not a lot of the meat is really what it comes down to. So opposites attract. US and Hong Kong stocks diverge. We've covered that a gazillion times, just trying to make the point. Here's from Seth Golden. Oversold threshold. I think this was today. Lowest S&P RSI since 2020, which was the COVID lows. So every single time you hit this level, you're going to get a monster bounce historically. Let's see if that holds true again this time. I would bet that that is correct. And so on. CPI came in better than expected. Inflation numbers were good this week. And that's that. Massive valuation gap between, US and China. Forward PE looking at 22, 23 in US, China looking at 12 times, and the earnings growth is accelerating in China, decelerating in the US. Cyclically adjusted PE ratio in the US, this is mind-boggling. Cyclically adjusted PE ratio in the US is 38 times, the highest it's been since 2022, before we had that big correction. And in China, it's only 10 times earnings, down from 30 times at a peak in 2011. So what does that tell you, ladies and gentlemen? Price is what you pay, value is what you get. You can buy at the top and ride it down, or buy at the bottom and ride it up. Choice is yours. GS retail favorites getting smoked. Value is outperforming and has been on the rising relative trend for a few months, especially in the US. Value outperforms growth. What have we been saying, ladies and gentlemen? Stocks have bottomed on March 12th in the past 20 years. You are here. So here we are, ladies and gentlemen. We've shown similar charts like this. Expect good things to happen in coming weeks or sooner. Takes the bulls, have a bull market. Okay, so here you can see here, when you get the bull bear sentiment this flushed out, you tend to get big recoveries. Sometimes you get double downs. We're not facing anything economically that I think would warrant these type of double rollovers that you're talking about here. Have we finally reached peak truck? This is part of our kind of theme. We're going to see more volume of houses, but they're going to be smaller. We're going to see more volume of cars, and they're also going to be smaller. Risk appetite completely flushed out. Sector outlook. Everyone's bullish on what's worked in the rear view mirror. I think there's going to be some opportunities here in consumer discretionary, which we have some. So staples, inflows, people crowded into defense and healthcare. That'll probably back off in coming weeks, and that's that. Let's go to some of the news. People underestimate the importance of Chinese President Xi's entrepreneurial meeting. That's from Alibaba's Joe Tsai. The importance of the meeting has been underestimated, adding that, quote, "It gave us the confidence to put our earnings back into CapEx investments." That's what you need to hear. China's way to drive economic growth is getting consumers to unleash $20 trillion of rainy day savings, says Alibaba chair Joe Tsai. They are pushing internal consumption, domestic consumption, and Alibaba is the toll taker for middle class and upper class high quality consumption, which is what they need to grow as an economy. And given the targets that they've set, that is exactly what they need. Alibaba releases AI model that reads emotions to take on OpenAI. US-China discuss a Trump-Xi summit for June. I mean, if I'd shown you these headlines last year, you would have said I was crazy. But I said this type of stuff was going to take place when you got a pragmatic administration in power as it relates to China. Yes, he's going to drive a hard deal. And yes, he wants to do business. He just wants to do business. Alibaba.com targets 100% AI adoption by merchants in 2025 in global expansion drive. Alibaba revamps Quark search engine into AI super assistant as China's tech race picks up. Chinese stocks find favor on DeepSeek trade as Citigroup downgrades US equities. How Alibaba's new RISC V chip hits the mark for China's tech's self-sufficiency drive. Oh, did I mention they're in the chip business, which we talked about a year ago? TSMC pitched Intel Foundry joint venture to NVIDIA, AMD Broadcom, sources say. Don't think that's going to happen with the new CEO. I think Lip-Bu Tan is going to say, thanks, but no thanks, ladies and gentlemen, I got it. Step aside. You need me more than I need you. You need capacity. I got capacity. Let me show you how it's done. There you go. Semiconductor veteran will succeed co-CEOs David Zisner and Michelle Johnston-Holthius. Intel CEO signals that he'll stick with contentious foundry plan. Of course he will. He knows it's a monopoly. It's the it will be a duopoly. Right now it's a monopoly run by TSMC. They're running the tables. Intel's coming to play. They have everything that NVIDIA needs and Avago needs, which is capacity. The reason NVIDIA's growth rate has decelerated from 250% revenue growth to lower than probably 40-30% by this year end of this year is not for lack of demand, it's for lack of ability to produce. Their business is reliant on the kindness of strangers, and TSMC can't give them more than $4 billion of revenue growth per quarter. And when the base gets bigger, it's a decelerating growth rate. And when you have a 30 times sales multiple, people say, I can't pay that multiple if growth is decelerating. Why it's decelerating is immaterial. The fact is it's decelerating. So you can tell me all day the cows come home, people can't get chips. And I'll tell you, yeah, that's exactly the problem. People can't get chips. Intel's going to solve that problem. Maybe it gives NVIDIA the chance to have a second wind once that capacity comes online. But in the meantime, they're handcuffed. And that's not going to change anytime soon until Lip-Bu-Tan saves the day. And like I said, if Lip-Bu-Tan saves the day, why would you be in a stock that could be a double called NVIDIA when you could be a stock that could be a 5 to 7 bagger in Intel if they actually deliver on what's needed by the Avagos, the AMDs, the NVIDIAs of the world? And that's what's going to take place. If anyone can do it, it's this guy. Gelsinger probably would have done a decent job. He was at the 5-yard line, but I just love how this played out. Kelly Blue Book report, new vehicle prices increased year over year in February with record EV incentives and booming 6-figure sales. So here is the average car price. So it's basically flatlined since February of 2022. This probably will start to go down by the end of the year as people opt for smaller or mid-sized cars and hybrids. These incentives went straight up. They're checking back a little bit. We need to see them around 9 or 10. And I think we're going to get there very, very soon once all these volumes start to come in, which is going to be a function. Oh, and by the way, the one thing that I didn't mention in all of those cycles, the other thing that didn't exist, which I'm kind of surprised that he brought up. I understood why he said it in the campaign when Trump said he wanted to make interest payments on car loans tax deductible for individuals. I was surprised I heard it after he got elected. So this guy's following through. He wants that in the tax package, taxes on tips eliminated and interest rates, interest on car loans deductible. You couple that with 40% greater population, oldest car fleet. I think we're being too conservative on this one is really what it comes down to. I thought I was being overly optimistic. Now I think I'm being too conservative. U.S. car buyers rush to dealer lots to avoid tariff-related price hikes. So they're going to try to jam in a lot of production before August 2nd, and buyers are going to jam in a lot of purchases, which all works. Boeing ties employee incentive plan to company-wide performance. Boeing's jet deliveries top Airbus for the second straight month. Kelly Ortberg, baby. Ladies and gentlemen, 4-bagger, 7 years, Rockwell Collins, and you're saying, I wonder if it's going to work. It's a duopoly. Weekly mortgage demand surges 11% higher as interest rates drop for the 6th straight week. Beacon QXO in, quote, friendly talks on $11 billion deal as QXO aims to double their EBITDA. Brad Jacobs strikes again. Let's go, baby. CEO Bracken Darrell brings VF Corp's reinvention back to Wall Street. So that is Emily Ratajkowski wearing the North Face brand. That can't be a bad thing, I'll tell you. Japan 10-year yield at highest since 2008 on bets for BOJ hikes. Now, that's an interesting story. So yield is the highest since 2008. But I think what they're also saying here is that so everyone's crowded into bets on BOJ hikes. Maybe if that's becoming crowded, maybe they'll delay it a little bit, which would also create the reprieve for the markets to rally into summer. So we'll keep an eye on that. The fact that everyone's crowding now into them doing hikes, we'll see. Euro on course for best week since 2009. Euro strong, dollar weak. Same playbook, different day. Stock market and sentiment results. We went through all the media. Here's VF Corp, ladies and gentlemen. You know, we were just pounding the table. Down here, our base is, I think, 1553 across all accounts. Shot right up to 28. Well, no, it didn't shoot right up to 28. It first went against us, like it always does, and then it went doubled. And now it's come back to check back, just like it does out of every single cycle. Shoots out, fakes everyone out, straight up, shoots out, fakes everyone out, straight up, shoots out, fakes everyone out straight up, doing the exact same thing here. The difference between this time and those 3 times is you got Bracken Darrell, who created a 26 bagger at Logitech after he came in as CEO when the stock was down 83%. There's a theme here, ladies and gentlemen. You notice what I'm doing here? Well, pay attention. So here's what you see. Cash flow is down. Now it's recovering. And he just basically laid out the plan that if and you need to read all of this, because the number one thing in a turnaround is solvency risk comes off the table. They did that by selling Supreme, $1.5 billion, paid down debt. Now they're re-accelerating. And what he basically said in Investor Day, and what you could extrapolate from that with the cost savings, with all the initiatives, with everything else, if the revenue didn't grow for the next decade, this would still be a double. And what he's also said in this at the same exact time, in the same exact breath, is that he can't see a scenario where they don't grow the whole business at least double digits. And he specifically says, I'm not here to grow anything less than double digits, which means the operating leverage is massive. And while we thought that we would ride this thing to $40, $45, $50 and have our double in a couple, 2-3 years, it more likely now looks like we're going to be holding this for a long time, and this thing's going to work its way back to new highs. And then, by the way, he also alluded to the fact, not a thing you do if you're in a period of survival, that we're going to get back to doing what VF Corp has done since the late 1800s, which is buy hot brands. So they're back in. They went from survival to stability to now re-accelerating growth to now to accelerating the growth and expanding again. And this thing's just getting started. So just bet on Bracken. All this will tell you why. All this will go through every detail of every plan, whether it's the lady who came over from Lululemon, who's going to get the women's sales in Vans humming again, or all of the other initiatives. But we will be here until tomorrow, and I got to go on CG10 America in a couple hours. So go through this at your leisure, but the key is this is going to be an unbelievable multi-year journey with Bracken Darrell, and we're super excited to be a part of it. The second one that we did here this week was Albemarle. I love Albemarle because the basic theme here is that, so you can kind of see the long-term view, very cyclical business. And by the way, it was this way even before EVs. So everyone's saying, oh, it only depends on EVs. Yes, but lithium prices are very cyclical. They go up and down. And what happens is when the price is up, all these producers overproduce, and the small ones go out of business. And the big ones like Albemarle just stop producing, wait it out, wait for all their competition to go out. And then they mint money 3 years later when the price just gallops because there's no producers left and they're left standing. They've got $3.5 billion of liquidity. All their competitors are going out of business. Oh, and by the way, China's got this unnaturally subsidized market in EVs. Everyone says, well, no one really wants EVs in America anymore. It doesn't matter. Everyone in China is going to be forced to drive EVs. They got, 40 million global stock is going to be 120 million global stock by 2027, 2028. That's all driven by China's forced, unnatural, subsidized markets. Don't hate the player, hate the game. I mean, if that's what they're going to do, and that's what they're telling you what they're going to do, how do you best position for it? Yeah, you can go figure out, is it going to be NIO? Is it going to be BYD? Is it going to be Tesla? Or you can just be the arms dealer and buy the lithium producer, the best one that has all the liquidity to wait this out. If it's another year, great. If we're already there, this thing goes straight up from 75 to 200 plus, 300 plus. And you don't have to think about it. You don't have to lose sleep about it. I mean, some things are just, some things are just too easy. It really is. I mean, I guess for most people, it's hard to sit through the bottoming process. I guess that's what makes it hard, or they don't read and do the work. But okay, so yeah, I guess this is hard, a bottom. So what was the price volatility here in the last bottom? So it got as low as 46 and it got as high as 80. So that's a lot of volatility for a lot of people. If they bought at 80 and it dropped to 46, they're and they're on leverage. But if they just said, wait a second, I know what I own here. I know what the cycle's like. So let's say they bought at 80, it went draw down against them to 45. Oh my God, it's going against me. Well, if you're not on leverage, you don't care because you know what you own. And then it went up to $326 in the next 2 years. So you made a 4-bagger on your 80. If you bought more down and you brought your basis down to 60, you made a 5 or 6-bagger, and life goes on. You know, the same thing in 2009, the same thing in 2000, and more likely than not, it'll be the same thing now. And but most people can't handle the volatility. So let's take a look at this base. It got as low as 71, shot up to 100, back to 71. What's our basis on this? $88.34. Oh, we're stupid people. Oh, we bought at 88 and now it's 71. Maybe we should sell in the hole. How about every new penny that we have available to put to work, we'll buy more? That makes more sense to me, because when it's 300 again, we're going to be glad that we were bringing our basis down from 88.34 to hopefully 77 when all is said and done. That's how we do it. On to the next. Here is sentiment. All right, so here's all the reasons why, yada, yada, yada. And by the way, the reason I have conviction is because I know every single word that's here. Okay, so you say, oh, I can just look at a chart and buy some. Yeah, then that's why you're going to be selling in the hole, because you don't know why you own it and you don't know what you own. And that's why I'm buying in the hole, because I do all this work and I know every little nook and cranny about every aspect of the business and their competitors and everything else. And that's why I can have conviction. And that's why I make this look easy, even though I guess it's not. I don't know. I never feel like I'm working, so it feels easy, but it's a lot of work. I mean, if you wanted to find that as work, I kind of feel like it's a treasure hunt. But so that's that. Sentiment's washed out. We know that. Earnings, industrials. Remember, we are in sandbagger season. That's what they do every year. But let's see what industrials did. They took them down 2% for this year. Exploration and production. These have stopped going down. They were going down double digits for a while. Now they're going down 1.8. I mean, look, I'll be honest. I'm probably going to do nothing with it. I was looking at Halliburton, HP, Helmerwick and Payne, whatever they're called, and Murphy Oil today. They're starting to look super interesting. I don't think I'm going to do anything with any of them because we love our Comstock resources. We have enough exposure, but we might. And if we do, it's going to be in the servicer space. And I think it's kind of ready. Insider buying in Celanese. There's a material stock, chemical stock. We love that space. But we have our exposure through Albemarle, and we're happy with that. So you saw the CPI numbers came in better than expected. The PPI numbers, core PPI and PPI, both came in a lot better than expected. So again, that puts the Fed put back in play. Earnings growth for this quarter is expected to be 7.3%. You know, the negative GDP noise, there's a lot of noise around inventories related to front loading of tariffs in the fourth quarter and some of the Long Beach people importing stuff. I can't even think of what it is, where trucks go in, not trucks, boats. Docks. Anyway, there was a rush to get a lot of goods in, so it might have pulled forward. So you might see a weak print in Q1. But when I look at these earnings, and even estimates, as much as they've come down, it's still at 271. They only took it down $4 from 275, and this is supposed to be the time of year when they take it down a lot more, and then they beat like crazy all year. So, and then they took next year up, the back end load, they took it up higher. So I don't think we're going to, I know the Atlanta GDP says that we're going to get a negative print. I don't know if that's going to be the case because they haven't been super accurate. Let's see what the Fed funds futures we're talking about today as it relates to a June cut. I just want to see if this is still at 90%. June, 89%. Is May on the table now? No, May's at 21%. And what about March 9th, next week? There's a 2% chance. So you're saying there's a chance. Very unlikely, but we could see a change in the dovish rhetoric. So leaving that aside, we're done with the podcast. For everyone who likes to stick around for the Ask Me Anything questions, which come from our listening studio audience, which we're excited to cover each week. We've got an awful lot this week, so we're going to go through them. At some point in time, we're going to have to be more selective because we're just getting so many now. But we'll continue to try to do every single question we can. And for those of you who don't stick around for the Ask Me Anything questions, we'll be back next week for the most amazing podcast of all time with the CEO of Cooper Standard. And we will be having more of those in the pipe with different CEOs moving forward. But next week's going to be super special. And for those of you who do get a lot of value from the Ask Me Anything questions, here we go. First one's from Johnny Salinas. Good afternoon, Tom. Was scanning through some charts. What do you think about Blackline down here? They're like a software Me Too company. I've never been able to understand what their mode is. So as cheap as they are and as attractive as they look, let me just take a look at their financials here. I mean, if their financials are okay, maybe I'll spend some time trying to figure out why anyone can't just copy and replicate their software. I mean, look at this. Look at this cash generation. Margins are going down a little bit. Not good in that type of business, but this is definitely worth looking at. I mean, this is one of those 2021 darlings that got overbid, and now let's see how many slices are in the pie. Revenues are still growing, although at a slower rate, so that's not good for that's a broken growth stock right there. What did they do with the shares as the stock fell? They increased them a little bit. They're probably paying themselves a lot of money in options and so on. But on balance, it's not terrible. Let's see here. Balance sheet, my guess is they have no debt. They got $800 million of cash, $800 million of debt. That's fine. Let's take a look at cash flow. Cash from operations, growing. Free cash flow, good. All right, let me tell me more about this amazing software you have. Cloud-based solutions to automate and streamline accounting and financial operations in the United States and international. Financial close and consolidation solutions such as account reconciliations, centralized workspace for users to collaborate on account reconciliations, transaction matching, individual transactions, financial data. Company also provides journal entry. I don't know. Sounds like a Me Too. So anyone using this in their business or working for a company that uses it, please send me a contact, hedgefundtips.com, click on contact. Tell me why it's better than anything else and why you continue to use it for a long time, or why it's just a Me Too product and you're planning on switching to something cheaper. Be interested to know. And this one is definitely worth doing more work on. So Johnny Salinas, hard maybe. Joe Rahman. Thanks for all you do. By the way, my daughters love your noodles. I'm kidding. Love your podcast. I am close to having enough to be a client in the next 1 to 2 years. All right, we will be here. I'm curious about what you think about Trump's executive orders regarding U.S. investment in China related to investing in Baba. Do you invest in ADRs or buy your contact shares on the Hong Kong markets? We've done both. When the fear of delisting was acute, we did some 9988. Once it was relieved after the PCAOB decision, we opted for the Baba. Look, we have three key filters in any investment. Number one is if JP Morgan was going to finance us to buy 100% of the company, the only caveat was I had to put up 100% of my net worth as the equity. They would be the debt. If it worked, I made insane multiples on my equity. If it didn't work, I'm wiped out completely and JP Morgan gets the business. Would I do the deal? On a numbers basis with Alibaba, I would do the deal 100%. On the country risk and government risk, particularly when it was looking really dark, you can't do that. But what you can do is pass filter number two, which was, and this was the filter I had to run in my head every single day during the darkest times in the last year and 2 years. If this position were to go to zero, would they take me out on a stretcher? And if the answer is yes, then either I don't go into the position or I go in a position size risk management that, although it's heavy and big and our largest position, if it were to go to zero, because there could always be something that you don't know that you can't control in any position that you're in. And once I got that down to a size where I could make a lot of money if I was right, but not get carried out on a stretcher. And all that means is, yes, it would hurt if it went to zero, but I have enough other good positions in enough size that I could still outperform even with that one sleeve going to zero and live another day, then I could live with it. And that's why I was able to lean the hell in when it dropped to 60 and back up the truck. Number one, a lot of the other positions had gone up and bought me the luxury to do that, like Google, like Amazon, like Rolls-Royce, like many others that were home runs, like Vornado. So that afforded me the ability to do that. But you can't guard against it. So what you have to do is say, how is this sized in my portfolio? And if you're a cowboy and you say, well, it's the best thing at the best price, and you just say, I hope it works out, and you put 100%, you deserve to die. I mean, that's die, Mr. Bond, I mean, what else could I tell you? So yeah, there's always a risk. And if it's not that on Baba, it's something else on something else. So that's the beauty. Like I say here every week, they don't give away multi-baggers for free, So what you can do is manage what you can control, not what you can't control. And yeah, I love to lean in size, and it is our biggest position, but I always had in the back of my mind that you had real risk. It could go to zero. So what does the rest of the portfolio look like in that situation? And I was very comfortable, and all those other stocks performed in the way that I needed them to buy me that luxury to do what I wanted to do on a numbers basis, despite the black swan risk. And that's the only way you can think about it. So yeah, Trump could wake up tomorrow and tweet something crazy, and that could happen. And that could happen with any company, whether it's Cooper Standard, whether it's Generac, whether it's General Motors, which we don't own, thank God. And that's the way it goes. So that's how you manage around it. Chris Williams, there are no sure things, and that the framework that you're operating from is incorrect, because if you have the view that there should be a sure thing, then you're a cowboy, and then you're going to gamble all of it in one and hope that you get rich overnight. And everyone that goes for that winds up getting broke. And the ones that do get rich overnight, let me give you a little secret: they give it all back to the casino. Okay, so create a durable, thoughtful framework that not only will keep you out of the stretcher, but allow you to compound money above trend meaningfully, regularly, and sleep well over time. And then the other filters were, if I were to walk into the board of directors and offer to take the entire company myself at the price it was quoted in the market, would they call security to have me escorted out of the room? The answer must be yes. The price, the margin of safety has to be so great that if I was to actually offer to buy the whole company, the board would have me removed from the building, because it was an unbelievably disrespectful, insulting offer. And that's where I like to buy stocks in the public markets that will never exist in the private markets. I can't tell you how many people come to me with private market deals every single day, and I say no. Number one, I have an obligation. I invest all of my money alongside with clients. I eat my own cooking. So that's rule number one for me. Rule number two, I like to sleep at night. And number three, I have control over the investments, so I know what I'm buying. And number four, I don't have the FOMO gene. Yeah, I'll miss some privates that wind up being 50 baggers. I could care less, because all those deal junkies, they take their 50 baggers and they put them in 10 or 15 subpar deals, and 14 of them go out, and they lose 90% of their 50 bagger gain. And then they wind up, starting from a much smaller base, finding a sensible manager that can compound it regularly. I've just seen it over and over. Okay, so that's that. That's how I live my life. Very simple. I only eat one cheeseburger a day. I don't need 10. I can have anything I want. I don't need any of that. If I've got an internet connection and a room, I'm a happy camper, and a golf club in the afternoon. Good on that. So what was curious what your thoughts are on AirCap CEO. saying if Boeing aircraft will go up by 40 million and every country besides US will be forced to go to Airbus. Go ahead, AirCap, go to Airbus. Have fun. You can get your next plane in 25 years. It's the dumbest thing I've ever heard. And as you said, sounds like a load of nonsense. You answered your own question, but fair point for pointing it out. And thanks for listening in. Ben, first name only. Thank you for your weekly podcast. Was wondering why the stock market went down on Tuesday. I thought you said you thought it would go up this week. Ben, I don't give a shit if it goes up or down in the next 2 days or a week and a half. That's not the game I'm in. I hope it goes down for the next 2 weeks. Do I think we're going to bounce here and start to rally into the summer? I do think so. And I think it's going to start imminently. If it's not last week and it's not this week, maybe it's next week, maybe it's the week. I don't give two shits. What I do care about is it created the opportunity to buy more of phenomenal business. The problem is our businesses, for the most part, didn't go down enough where I felt like a fear of loss. Why don't I have more available capital to put to work? It's like they're kind of just hanging around, churning around while tech gets smashed, and then they'll go back up. So I'm just sitting here waiting and watching, and where I have some new money come in, I put more to work at lower prices, and then it'll rip up and won't allow anyone in, and everyone will be like, oh, what happened? And then they'll all want to buy in July when we're actually taking off a couple of positions and finding 2 brand new positions to replace them because they're at full value. So welcome to the podcast. I can assume by the nature of your question, you're brand new. Nish Patel, Tom, been listening to you for over a year. Thank you for all the great information you give. What are your thoughts on TTD? Seems to fall seems very oversold. Leader in the sector, didn't have really bad earnings, looks to be a buying opportunity. We covered this one a couple weeks ago. I said no. Let me take a look at it again. Yeah, this is a broken Momo stock. Call me up again if it goes to like 40. I don't like these things. These are Momo stocks that get broken. Maybe they bounce, dead cat bounces, but I like businesses that have been around for decades, that I can just see how they operate through cycles. This stuff is like guessing for me, and I don't like to guess. I like to earn. So let's just look at the cash flow, so maybe I can save us some time. Yeah, it's generating a boatload of cash. Ugh. Wow. All right. Revenue's growing. Income statement. Let's see what they did with the share count. Not terrible. What is this? This is that ad serving business. Yeah, self-service, cloud-based ad buying platform, optimized, data-driven, and very trade desk. All right, 30 times. All right, I think this is going lower, but it's... I'll take a look at it. It's kind of interesting, but I guarantee you I'm going to do nothing with this one. It's just not the thing I do. I stick to what I'm good at. This is not something I'm good at. Griffin Brown, hi Tom, 23-year-old kid here, recently gotten into investing, stock analysis, found your podcast a few months, haven't missed an episode since. Thank you, welcome. Tell your friends, Griffin, awesome stuff. When you receive a stock idea, what do you immediately look to determine its validity? Yeah, 2 things. It seems like I'm answering in 1 minute, but behind that 1 minute is 20 some odd years of experience. So like I've seen it all, or at least most of it. And I just know the nature of certain types of businesses that I avoid and the nature of certain types of businesses that I get interested in. But then I'm looking at solvency risk is number 1. If the stock's down a lot, is the balance sheet good? Does it generate enough cash? How has it operated through past cycles? Are they keeping the share count relative? Then I might look at some multiples, just enough to determine whether the margin of safety is large enough that I actually want to spend the next 3 weeks digging into it and its competition or not. And that's usually a good starting point. Chris Patterson, given Albemarle's significant reduction in CapEx, how do you see the impact on company's long-term growth prospects, expanding lithium capacity to meet future demand? I see that they do this every single cycle since they've existed. They basically, the small players come in when the price of lithium goes up at the top, excess capacity comes on board, they flood the market, the little guys go out of business because they can't stay afloat as prices collapse. Companies like Albemarle, they have ample liquidity as one of the largest lithium providers in the world, and they just wait it out till their competition goes out of business, supply comes offline, demand continues or returns, and then they're the only game in town on the way up, and they mint money, and then you get out at the top when all the new entrants come in, like every time. Dustin D, appreciating any guidance on best places to learn more about value at risk or risk-adjusted portfolio allocation strategies. Dustin, that's a load of bullshit. Basically, you want to underwrite each individual position as if you were buying the entire company. And if you're lucky, you'll be able to find 8 to 12 of those that you want to own at a particular time. But you should assume and treat each one as if you have 100% of your net worth tied up in the equity. And if you're wrong, you're wiped out. And then on that basis, you underwrite 8 to 12 individual uncorrelated risks, discrete from VAR, which measures against an index or some other bullshit consultant metric that's never going to make you any money. So I will leave that there. Nice question. Hayes W. Okay. Hope you're doing well. Thank you for your time and energy making the podcast. Greatly appreciated by many, myself included. You're welcome. Thank you. Johnson Outdoors, quality portfolio of outdoor recreation brands. Low debt, beaten down, All right, I'll take a look. I don't like this recreation business, like the Malibu boats and the all this other stuff, but I'll take a look. They're all going to bounce. Leslie's out. There's a lot of them. I think they're going to start working. Yeah, this looks interesting. JOUT. So no one wants this stuff right now because it's consumer discretionary. And for 5 minutes, consumer sentiment is down because of the tariffs. Once that's resolved, like every 4 years. All right, so cash flow is starting to recover. Revenues are still down. Margins are collapsing. So you just have to kind of get a sense of how they operate through each cycle and what's their turnaround plan. Do they have a decent balance sheet? Let's take a look at the balance sheet. If they have enough runway, 162 million, and the debt is 0. So that's a good start. You just have leases. Let's take a look at their cash flow. And yeah, so. Let's take a look at this. Wow, so they really peaked during COVID. So their revenues are like back down to pre-COVID levels. What's their share count doing here? Yeah, they've done okay with the share count. So look, they're in a hard spot. You got to understand the turnaround story. I'd probably get more interested in, it probably goes, around 20, it would get interested, but this is a really broken stock, so it may take a while to recover. But I think it will. And I just don't like this type of business, but I think you're going to be right. And I think it's okay. It's generally okay if you can get comfort with their plan for turnaround. Not make sure it's cyclical and not secular is what I'm telling you. Are any of those brands dead, or are they just going to, bounce back like Vans and different things that have been around for 60 years? Lee Foster, love your pod. It's such a treat to hit Friday. I watch while working from home on Fridays. Can I ask your opinion on the Buy Canadian movement and if it will have any material upside for Canada Goose and potentially outweigh tariff concerns? Seems a bit oversold to me. Look, Goose's recovery is mostly about China. So I'm not really, I mean, yeah, it needs America, it needs all that stuff. But again, that's stuff, not stuff you can control. Buy Canadian is irrelevant because if your economy is weak, your Canadians aren't going to have any money to spend. I think it's going to get resolved with the new prime minister. And if not, we welcome you as the 51st state, and Wayne Gretzky will be a great governor. So I'm joking, not joking, but I think it's going to go better than you guys anticipate, and it has really limited bearing on the small position we have in Goose, which we hope to make a much larger position soon. Really enjoy the podcast. You have great understanding and opinion on market trends as well as individual stocks. Thank you. Was wondering. Used to. I'm used to. Okay. When did it not work? I'm used to all of your analysis coming true. Want to know how you handle times that. I mean, my biggest mistakes are generally timing, and I'll just cover this. I'll tell you, like Range Resources is a good example. We bought at $11. It immediately shot up in 2018. It immediately shot up to 18. We thought we were geniuses. Then COVID came and it crashed down to 160. We bought like crazy, brought our basis down to 410. So we just, it's a huge markdown short term. It enabled us to like quadruple the position size and then ride it. And why did we have confidence to do that when everyone else was bailing out? Is pretty simple, because while they have to report 10-year proved reserves to the SEC, we did an analysis of the unproved reserves, and we figured it was worth, somewhere around $60. And so, like, would we have liked it to bottom at 11 and then go to 60? Yes. Would we have liked it to go? But it worked out for the best because we were able to hugely increase the size of the position and now ride it all the way up. And we think we still have juice left in this. So, the main thing is if you underwrite it properly, the only thing that's going to cost, where you can lose is it takes longer than you expect. And that's why you got to have, more than one position. We talked about Charlie Munger's BYD, okay? And BYD was a disaster, okay? So he bought it in 2009 up here somewhere. Then you had a drawdown from 10 to 5, so 50% drawdown. So you lost 3 years use of money, and you were down 50% if you followed Munger into that. Oh, that's Boyd Gaming. Where's BYDDY? There we go. The Chinese electric company. So you bought it up here in 2009 or wherever it was, 20 down to 2, so 90% drawdown. Then I don't know whether they added in the hole or not, but they held on to it for sure. And it basically did nothing for 10 years. And then you had a 10-bagger in 12 months. So, over that time, if they've got a, average basis of $5-10 and they wind up with an 8-bagger, the IRR is pretty damn good, 800% in 12 years. So, because he knew what he owned and he was betting on the jockey and the whole thing. So I think the biggest, once you learn how to underwrite a business and you avoid the ones that you wouldn't put 100% of your net worth in, either because you don't have confidence because you haven't done enough work, or you don't have confidence because it's not a good enough business, and you ignore the ones that are going to be good trades just because you think the price is going to go up and you may prove to be right. Who gives a shit? The question is it a good enough business that you would stake the whole ranch on it? And that's what you want to make a portfolio out of. And be humble enough to know that you can't know everything. I couldn't predict that COVID was going to come and crash it from 11 down to $1.60 something cents. But I did know that the intrinsic value was still there, and it gave me an opportunity to get 4 times the position than I would have had if it went perfectly. So that's how you got to manage it. You got to do the work up front is what it comes down to, the work up front. And if you really have to be in a position that you don't have 100% certainty of, but you like the risk reward, then you got to just manage around. Usually those have an expected value of 10x. You just got to size the position down and assume it's like an option position and it's a 2 or 3% position. And if it goes to 0, you accounted for that by the sizing. So if it worked, it would add 2,000 basis points or 20% of excess contribution. But if it didn't work, you lost 200 basis points. And that's probably a reasonable risk if it's well underwritten, knowing that you can only have an EV of 10 if there's a possibility of a 0. But I wouldn't take many of those. That's for damn sure. I would take them very, very selectively and very rarely, because I generally don't want to put any money to work if I can't make it a real position of, 7, 8, 10, 12, in some cases as high as 20%, but that's only happened once or twice in a career. We're talking COVID when, Exxon was trading at $33 and Wells Fargo was trading at $25. I mean, those are times when you gotta, when it's raining gold, you gotta pull out the bucket, not the thimble. And Baba, so that's that. JT Investor, you shared thoughts on Tesla in the past. Do you think the extreme negative sentiment has created an attractive entry point finally on this stock? Seems like a long-term growth thesis is still intact. Political bias weighing on the stock at this time could be a temporary overhang. What are your thoughts? Look, I would never, I never have bet for or against Elon Musk, and I never will bet. I won't say I'll never bet for him, because I may, but as a car company, this thing's way overvalued and their deliveries are going down. So you're making a bet that what he's been promising for years and not yet delivered, full self-driving, automated robots and robo-taxis, he delivers all of them. And I wouldn't bet against that. I can't value it, so I just avoid it. It's like, I don't have the FOMO gene. So like, I never bet what does Buffett say? He said, never bet what you have and need for what you don't have and don't need, or something along those lines. Anyway, the point is that this is not where I excel. I'm not a guy that's going to predict the future, and I have to have a leap of faith. I like businesses where I can see the cash and the price is just vacillated to 2 or 3 standard deviations below the cash flow trend, and I can just play the mean reversion. So this kind of stuff, God bless it. And there are people probably make a 5x from this at some point. I mean, look, if this thing shot down to 100 on some ridiculous thing, maybe I'd take a punt on it. I don't know, even at 100, if I could put clients in it and sleep at night. I mean, this would be like something I'd just be like, guys, I can't risk client money in this. And I just tell everyone I'm going to buy a bunch of shares personally, and I encourage you to do it, but we can't take this level of risk in the portfolio. It's a punt. It's a gamble. It's a great jockey, but I can't get my hands around the valuation unless I have certainty that he's going to deliver on any of these things, or if other people are going to. I don't do that. That's not what I do. So the other thing that I don't do is I don't have to participate in every stock that's in the headlines. As a matter of fact, I've made all my money participating in stocks that are not in the headlines and selling them when they are in the headlines. So the fact that Tesla is in the headlines every day tells me I'm not interested. There will be a time, if this thing is going to be a bargain, that it will not be in the headlines at all for 6 months. No one will be talking about it. That's when you want to buy. Right now, you probably get a bounce. It's not interesting enough for me. I never bet against the guy. He's a genius. All right. Thoughts on DK wants thoughts on Target. I think we covered this last week, DK. Certainly closer to a buy point than a sell point. I'm not ready to buy this one. So no change from last week. I think it's getting close to the point where you want to own it, but I just don't generally like that business. President Trump had a media event with Elon Musk, declared he will double U.S. auto production from Tesla. I've contacted CPS Investor Relations, but they never provided a breakdown of what car models we're supplying to, if not at all. I've told you on the podcast that they supply to Tesla. They just don't. They're not allowed to use the logo in their pitch deck. And that would not be a decision. That would not have any bearing on whether I invest in Cooper Standard or not, even though it affirmed what you were hoping to hear. It's kind of useless information. Professor Tom, the globalization is stopping and countries are moving towards one's best interests. Does this affect your thesis on Baba? Baba's not an exporter, so why would that affect my thesis on Baba? Would you hold it past 2029? Trump's second term, if it didn't reach intrinsic value. Tesla being there was a major reason I invested in China. I don't know how you connect those dots. I apologize. It was a long question. Apology accepted. Sharing your knowledge means a lot. Well, thank you very much. And thank you for having the courage to send in a question, Jimmy Jones. I still don't know what your question is. Oh, some theory about globalization, deglobalization has nothing to do with my investment in Alibaba. I can assure you none of my macro opinions have anything to do with how I underwrite individual companies for the next 3 to 5 years. As for whether I'll own it after Trump is in or out, my sense is this is going to move a lot faster than everyone thinks, and it's going to exceed my estimates of intrinsic value sooner than I think it is. And I'm going to sell it at that level, and it's going to go up a lot more than I thought it would. And for 18 months, I'm going to regret selling it at a price that I thought was insane. And then 24 months after that, I'm going to be glad that I was not a pig and didn't get slaughtered with the rest of them. I'll leave it at that. Felipe Andrew Pincos. Celanese. Yes, we like it. We've said we liked it. We don't own it at this time. NFE bought some insider stocks. That's from Brady Todaro. I don't like this. Look, I like I like Comstock. I don't like these other producers because I don't know enough about their assets, and I'm not going to spend 6 months to answer an Ask Me Anything question like I did understanding Range Resources and Comstock Resources and EQT and making the decisions that I did to do Range a while ago, Comstock more recently at $8 and change, just around Jerry Jones basis. Where's NFE? Yeah, this has been around for 5 minutes. You're probably okay, but I just like better quality stuff and better quality management teams. Cole, especially in the oil patch. Cole Fleischman, new job as an investment analyst, wondering what news you use to stay up to date. I mean, the basics, like you say here, for general stuff, you get the sell side research, Wall Street Journal, Barron's, Bloomberg. Yes, get all of those. That's the minimum. Financial Times. You seem very knowledgeable on everything that's going on. Yeah, I read nonstop like Buffett. I mean, because I love it. So yeah, those 5 are the starting points. And then the more you read, the more you're going to learn about other things to read, industry publications, depending what holdings you have, et cetera. Thoughts on A&F, Abercrombie and Finch. Yeah, I'm looking. I mean, I've got enough discretionary, but I'm keeping my eyes open because they've got, no, not yet. This is a broken momentum stock. Not even thinking about it yet. Edgard, Constellation Energy. I don't know why people are so in love with this stock. CEG. No, not yet. All right, so Brady's asking, we have to refinance all this debt this year. Look, that's why they're doing what they're doing right now to bring down rates. I mean, part of this tariff nonsense about fentanyl, and yeah, that's part of it for sure, but it's also to create some volatility to get bond yields down so they can refinance as much of it as possible. Today was a little bumpy because of the 30-year auction. So yeah, it's a thing, and the administration is on top of it. And Besson told you exactly that. We're going to move very quickly from tariff rattling to growth initiatives, i.e. tax cuts, deregulation, and the market's going to hockey stick straight up into the summer, and no one's going to wonder why, and it's not going to let people in. And then in July, they're going to buy just in time for the fall weakness. Greg Altamari, what's your take on DDL, a Chinese grocery store? Answer is no. Okay, basically, if it's not one of the biggest companies in China that's been around for decades, I won't touch it because half of them wind up being frauds. And you say, well, that's pretty harsh, Tom. Well, yeah, if you've been around markets for 20 years, you've seen all kinds of stuff happen in China. So I'm not willing to take country and company, even though there are hundreds of companies that on paper in China look like the best thing I've ever seen in my life. Complete wet dreams of financial balance sheet income statement. I won't touch them with a 10-foot pole. And I'm sticking to that. That's that. Matt Glasshour, thank you for continuing to do your weekly podcast. You're welcome. I found you about a year ago. I've been following you. Baba, CPS, GXO. Your approach has completely changed my investment outlook and has drastically changed my portfolio for the better. What are your thoughts on Estee Lauder? Well, we've covered that a lot. We like it a lot, and it's a play on the China recovery. So you just have to be patient with that. But I've been talking a lot with the makeup people, both at Fox, and this week I talked with the ones at Yahoo. Apparently they destroyed the MAC brand, but beyond that, it's a great quality product and it's a complete play. He's talking about it as a play on Russia. I think you're right, but it's more of a play on China, which is just starting. So that one's going to be fine in our view. And as it starts to show signs of improvement, that might be one we would actually buy up as it really starts to prove itself. And it's not at that level yet. ASML, one of the greatest businesses in the world, from Chad Lamborn. It's come down a little bit. Not for me yet. I mean, if this thing, God forbid, this got down to $500, this would potentially be one of the bigger positions in the portfolio, but it would probably still be smaller than Intel. Best content on any media. Thank you. That's very kind of you. Divis Lung. What's your opinion on Wayfair? Not thrilled with the CEO. If they change the CEO, I'd probably get very interested. Thomas Barr, found a couple gems. I'm curious your thought. Culp and Kirk. Please only send one name per question. Let me see this one. Culp is burning cash and the revenues are declining, deserves to be cheap. So tell me what the turnaround story is. I'm not interested in. Kirk. This one is called solvency analysis. Man, you like companies that burn cash and decline revenues. I don't sleep with companies that burn cash and decline revenues. What do they do? Home decor and furnishings in the U.S. This is a housing play. It's a function of rates. So it's like Generac and Stanley. So I would never own this as a third because I already have two of those housing plays and rates plays. But yeah, this is like Leggett and Platt. Free cash flow is burning. What's happening with the balance sheet? $4 million of cash. I got some. How much accounts receivable do they have? A lot less than they're payable. Wait, let me see something here. What the hell is? Oh, scratch that. Liabilities. Here we go. Oh, long-term debt is 34 million. Wait a second. Why are these numbers so different? What was I just looking at? All right, so they do. Oh, they have accounts payable of 46 million. They have no accounts receivable, and they have 34 million in long-term debt, 3 million of cash. I mean, I totally see what you're seeing in terms of a trade, but Let's see if have they diluted? Have they raised equity? No. Share counts. This one's super risky. This is like a PA punt, but I think it might work. If it doesn't go bankrupt, you're going to make a multi-bagger, but it's definitely not looking great right now. So I'd have to really dig in on their turnaround story and see some signs of improvement, because the financials are just showing me death by 1,000 cuts. Rob S. Appreciate all the consistent great knowledge you share. Was wondering why you prefer to buy the suppliers of home builders than the home builders. We covered that. Yeah, so that's good. I read your mind, and we covered it today. Goran Stojcic. Okay, he's talking about the whole policy thing with related to China. These are all the people who missed the move up from 70 to 140 that are now saying, yeah, but what if you're wrong? What if you're wrong? Look, we knew these risks when we got in at now a blended basis of 83, a lot in the hundreds, a lot more in the 60s. And that's why it's not the only position in the portfolio, because on a numbers basis and on what they're doing basis, it would easily be 110% of our net worth, except you just have to assume there's some risk of what you don't know that you don't know. And if it goes to zero, do you live another day? But I think the highest, most acute level of that risk during the Biden administration was alleviated by the PCAOB decision. And that's all you can do. So, this is a calculated risk game. And with every position, I mean, these are known risks. With every other position, there are unknown risks that you don't know that you don't even know. And that's why you have a position, you could have a portfolio of 15 to 30 or 40 stocks, but you're never going to outperform. But you can't, maybe you could do what Buffett with what Munger talks about and have, 4 or 5 is enough diversification. But, if you lose one of those, the other 4 better be damn good to out earn and then still be able to outperform. So I don't like that game. I like the 8 to 12 game, sometimes a little more, maybe even push up to 14, 15 at certain points in the market. But best base case is more concentrated and accepting the risk in each discrete underwriting and going in with my eyes wide open. So the answer to your question is, yeah, I see what you see. So does everyone else. And it's up 100%. So there's that. With that said, I want to thank everyone for tuning in. We're going to be back next time, same place next week, except we're going to have the most amazing guest in CEO Jeff Edwards of Cooper Standard. You won't believe what he's done to set this thing up for the next phase of this cycle turn. We've seen the nascent stages, and the party's just getting started. So with that said, see you next week. In the meantime, make it a great one. Bye for now.